Hi, everyone. Before we get started today, just want to give you a reminder of what it is what I'm trying to do here with playing the unicorn. So, basically, I'm trying to share everything I wish I knew when I was 20 and starting out as a budding entrepreneur. And so it takes many different forms. It could be presenting something I learned from building an MVP to how to fundraise from VCs to having guests who share interesting insights, be it their journey or something they've done. Now, this week we have something really special. So I don't know how well your week has been going, or your day is going specifically. But today, a company that I'm a co-sponsor of went public on the Nasdaq, and it's a SPAC to take a company from Latin America public. And in a way, I want to credit you guys, the audience, for suggesting it. A few months ago, had our resident venture capital expert at FJ Labs, Jeff Weinstein, who's like a historian of the topic and was known as Venture Boy in the team, who presented venture capital. And as I was asking the audience, what you thought we should do as a topic on an ongoing basis, many of you said we should cover SPACs. What are SPACs? How do they work, etc. So Jeff came on board, and I think is quickly becoming, we're going to be renamed as a moniker from Venture Boy to SPAC Boy, and presented what SPACs are. And in a way, it led us down a rabbit hole where we became interested in them, and reconnected with my old partner in crime, Alec Oxenford, who's co-CEO and co-founder of OLX with me, who is going down the path of creating a SPAC to take a company from Latin America public. And lo and behold, a few months later, we actually did it. We launched the SPAC. We rang the bell on the Nasdaq this morning and went public. So before so what we're going to cover today is actually how to launch a SPAC and perhaps why we launch a SPAC and what the intent is. And to do that, Jeff is going to come on and he's going to interview the CFO of Alpha Capital, which is the SPAC that we launched today. And they're going to have a nice conversation. But before we do that, I'll play for you slightly formal video, but I'm very proud of it because it happened this morning, of Alpha Capital, why we're doing it, and its IPO this morning.
This is an exciting day for us at Alpha. First, I'd like to thank our great friends from Nasdaq for extending us such a warm welcome. We've spent the last few decades building, growing, operating, and investing in tech companies in Latin America. And it's this experience, along with the relationships we've formed and the deep connections we've established to the sector, to the region, that will allow us to partner with the best founders and the best companies there.
We have seen in Latin America very fast adoption of technology, fostered by the high availability of smartphones, over 93% penetration, and availability of broadband in all urban areas. This has fueled the industry of technology in the region, not just in number of companies, over 20,000, but also in the size of them. One unicorn emerging after the other, 37 until the end of 2020. All of them in search for late-stage capital. Only a few companies have made it to the US capital markets through an IPO. All of the others are in need of this vital asset. And that's where we see a great fit for Alpha Capital, being the first SPAC devoted to technology in Latin America and helping this industry to foster, and with that, the economic and the social development of the region. We want to hand over now to our co-sponsors, Veronica Serra from Innova Capital and Fabrice Grinda from FJ Labs.
As an experienced investor in technology in Latin America, I'm very excited to be part of the Alpha team, supporting what is the first ever SPAC focused in technology in the region, a region with enormous potential and ready to access the public markets through Nasdaq.
Over the years, I've invested in nearly 700 startups all around the world, and the conditions are now set in Latin America to take a number of these companies public. And Alpha Capital is perfectly positioned to do so, given both the brand we've established with all these companies and the relationships that we have with them.
Alpha is about helping the most driven and talented entrepreneurs from Latin America to unlock the full potential of their ideas. This is why We feel so extremely fortunate today to be part of this amazing adventure and this very important milestone forward. Thank you.
So as you can see, this is really cool. I'm very proud that it happened today. And again, wanted to thank you for the inspiration that got us here. And so if you have ideas of things we should do, things we should pursue, definitely push them, because sometimes we actually go and execute. So whether it's ideas for topics we should cover or guests we should have or whatever, go ahead and share them. So without further ado, let's start today's show. So welcome to Playing with the Unicorns, episode 20. So you want to launch a SPAC. So Jeff, Rahim, thank you for joining me today.
Thank you, Fabrice.
Okay, so
thank you for having me, guys.
So what I'll do is I'll hand it over to Jeff, and you guys can have a conversation that will enlighten us on how to launch a SPAC, and I'll see you guys at the end of the conversation.
All right, thank you, Fabrice. As Fabrice mentioned, I'm really excited to be doing today's podcast. This is a couple of months in the making, and I've gotten to know Rahim, and he is an incredibly impressive guy. So I don't have to dwell too much on what Fabrice has already told us. As we've now discussed, Alpha Capital closed a $230 million IPO on the NASDAQ market. It's trading under the ticker ASPCU, and today the team rang the proverbial opening bell on the exchange. And we at FJ are extremely fortunate, extremely proud to be co-sponsors of the SPAC, which is dedicated to taking public a tech company in Latin America. And I'm excited to have with us Alpha's CFO, Rahim Lakhani. So we're going to get a bit more tactical in our discussion today. I'm going to assume that our listeners already have a base understanding of what a SPAC is, how it works. And if not, I'd encourage you to watch the presentation that we did on Playing with Unicorns a number of weeks ago, which was called What's the Deal with SPACs? So without further ado, I'd like to welcome Rahim from Alpha Capital. Rahim, thank you so much for joining us at such an exciting time. Congrats again on the IPO. Let's start, if you could just tell us a bit about your background and what brought you to working with Alec, Rafa, and the Alpha team.
Yeah, absolutely. So first of all, thank you, Jeff and Fabrice, for having me on Playing with Unicorns. And a big congratulations to you guys as well. Very, very exciting times. I remember, Jeff, when you and I first spoke back in December about partnering up on this. It seems so long ago, but we accomplished so much in the last couple of months. It's great, and we at Alpha Capital are very excited about partnering with you guys on this exciting journey. Yeah, so a little background on myself. I have been a finance leader in different operating companies in my career, and have been lucky enough to experience and work with both high growth companies in different regions as well as different industries. So before I joined the tech world, I was CFO for Anheuser-Busch InBev in India and Southeast Asia, where I led a team of over 100 people, worked on an integration there. While I was in India, I was based both in Bangalore as well as Delhi. And then after that, I joined a startup called Offerpad, which is very similar to Opendoor, which is, I believe, one of your very early investments. I was the COO there for a while, as well as CFO. Post that, I joined LetGo, and that's how I met Alec at LetGo. I was head of New York office. I led sales, strategy, and finance while I was at LetGo with Alec.
That's great. And what first piqued your interest with the SPAC model, and when did you realize this might be something interesting to pursue?
Yeah, so it's funny, Alec, I should say, got approached by an investment bank in New York back in very actually late spring in April, when things were a bit crazy, and we were introduced to SPAC as a product, and we tried to learn a little bit about it at that point, but we had just announced at that moment, just a month before that, a merger between OfferUp and LetGo. So we were both very focused on that. We didn't really have as much time, but over the rest of the summer, SPACs became very, very popular. And what happened was, you had very interesting and intriguing sponsors also joining to, launch SPACs. So it kind of piqued our interest more and more. After we finished the transaction of Let Go and OfferUp in the fall, both of us started really working on full time, with of course, Raphael Steinhauser, who's also the co-founder of Alpha Capital, our team, and of course, you guys.
Yeah, it's pretty amazing. So obviously in the US right now, you can call it Spac Mania, you can call it euphoria. There's certainly no shortage of SPACs being launched. What makes for a good SPAC sponsor?
Yeah, that's a very interesting question, because initially when we looked at SPACs, it felt like everybody was trying to launch one. It just seemed, when you look at it superficially, to be very honest, it seemed like, oh, there's potentially a bubble or something like that. So, we kind of really did a lot of digging deep into this, and what we think makes a really good sponsor is someone who's trying to use this product called SPAC. That's the way we like to look at it, and solve a real problem, right? And the first question to ourselves was, as sponsors, was like, okay, can we use this product to solve a problem that has not been solved yet? Can we find the right team to solve it with, such as our management team and co-sponsors? And will we be good at it, right? And those are the questions we asked instead of just saying, let's launch a SPAC. We were really deliberate about it. It took us a long time to put together a thesis. So, after thinking about this, we're like, okay, what problem are we trying to solve, right? So, our decision at that point was, we have a lot of expertise with our co-sponsors in Latin America. Of course, Alec has launched multiple startups with Fabrice in that region that had a lot of expertise. So we're like, okay, this can be very interesting. So let's look into it a little bit deeper, right? So we looked at Latin America as a region, found very, very good macro picture. So very high internet penetration, but very low e-commerce penetration, right? So 5% e-commerce, but 70% internet penetration. We were like, okay, that's really interesting. So there's an opportunity. Then you look at GDP per capita, and you're like, okay, that is also very interesting because you have GDP per capita of $10,000. You have somewhere like India, which is $3,000. Believe it or not, the GDP per capita for LATAM is the same as China. And then you're like, okay, that is also very interesting. But as a tech sector, it receives very less funding compared to a region like India, right? India has 3,000 GDP per capita. LATAM has 10,000. And then if you look at the funding, it receives half the amount of funding as India. And then, we also looked at, publicly traded tech companies as a percentage of GDP, which was also very interesting. In US, that number is 40%. China is 28%. India is 14%. LATAM is 2.5%. So, we were like, okay, this is so interesting. Such great macro picture. Very good, internet, very, very good technology adoption, but very little funding. So we were like, okay, this is a problem that we can solve, and we have a team that knows a lot about the region. We can solve it together. So, putting together fast adoption of technology, very good macro picture, yet capital starvation is, that is, as a team, all of us, decided to solve as a problem using SPAC as a product.
It makes tons of sense. And presumably that's the reasoning that you guys went with the geographic mandate, because a lot of SPACs do not.
Yeah, you're absolutely correct. But believe it or not, Jeff, we were pretty, initially hard-headed about it, I like to say, because, we were told, oh, don't focus yourself so much, you want to be broad. And, we really believed in solving a problem, and, if you really want to focus on solving a problem, you got to be really, really focused. And that is what, the sponsors really wanted to do. So we were pushed against it in the beginning, to be very honest, but we were like, no, we think we can use this product to solve a very specific problem, and that's how Alpha was born.
Do you find that investors appreciate the geographic focus?
They really, and I think, sometimes you also get lucky with timing. I would say, the feedback we got from our investors was, very much so. Investors really loved that we were very, very focused, and we were focused to solve a problem with people who have expertise in solving this problem, who know the region, right? I mean, you have, of course, Alec, you have Fabrice, you have Jose, you have Veronica, Sarah is a sponsor. They all know the region really, really well. And so the investors were very open to it, especially now that there's been so many SPACs in the U.S. with not so much focus. So they're like, okay, this is really interesting. You are really going after a problem. They were very, very receptive to it.
I think that's also one of the cool things about Alpha is the operator and entrepreneurs leading it.
Yeah.
Whereas you see a lot, I mean, frankly, in the US now you're seeing celebrities like Alex Rodriguez and Colin Kaepernick, and then you're just seeing purely financial sponsors. Do you think that having a SPAC led by operators might be an advantage?
Yeah, so I definitely think so. And, just as a finance person and a finance nerd, me myself, I love to work with, I think, I am not as well suited myself to launch a SPAC. It's great to work with entrepreneurs because, people have complementary skills, right? When you look at, I'll just, use myself an example. As a finance person, I'm trained to look at a range of range of outcomes and assign probabilities, right? And as a finance person, you're always, kind of conservative and not assigning equal weighted probabilities or being more conservative. What I love about working with entrepreneurs, Fabrice, Jose, Alec, is they really focus on the right tail of the outcomes, right? Instead of saying, okay, they're all equally weighted, they're like, no, how do we make this part come true? What do we need to do? And it's really great to kind of have that mindset from entrepreneurs. And then if you add someone like Raphael Steinhauser, who has been a very senior corporate executive in the LATAM region. He was, president for Cisco, president for Qualcomm, operator, good finance expertise, trying to solve a problem with entrepreneurs. I think it makes a huge difference personally, at least my belief.
And by the way, a SPAC itself is an entrepreneurial endeavor. And it's not as easy as snapping your fingers and saying, oh, voila, a SPAC. Yeah. So like to the point of the title of the episode, so you want to raise a SPAC. I mean, can you talk to us a bit about what you have to do to even prepare for one? And I mean, I talk a little bit about some of the complexities and the challenges.
Yeah, that's so interesting that you asked that question. I think there's definitely two types of SPAC, right? You have many established private equity fund, venture capital funds raising SPACs. They already have an infrastructure in place. They have an accounting team in place, a finance team in place. They have capital markets expertise. But if you're a kind of operator, entrepreneur-led SPAC, you really don't have that. So we were all I am as a CFO, the accountant, the guy who's making expense reimbursements, helping closing documentation. So there's a lot of startup entrepreneurial part built into a SPAC like ours. And it takes a long time. You have to kind of set up the infrastructure to be able to go out and do this. And put a lot of effort into it. It seems these days as fast as they're launching that it's fairly simple. But if you really are a startup entrepreneurial-led SPAC, it takes a long time. It takes a lot of effort too. And I think the key also, Jeff, one thing I would mention is finding the right partners to be able to do this. And by partners, not just management team, but also co-sponsors, also the right law firm, the right bankers who kind of see the problem you're trying to solve with the same eyes. I think it's really, really important to have the right partners.
Yeah. So, okay, you've decided there's a real problem to be solved. We want to raise this SPAC. First of all, how do you figure out how much you want to raise, and how do you figure out where to take it from there?
Yeah. So I will say I wish it was very, very mathematical, but unfortunately we decided to raise a SPAC $200 million. Thinking that kind of works really well for the target we're going after, right? So, you've seen SPAC deals, SPAC size time, times 5 or 6 being done, but you also seen times 10 being done if you raise a large enough pipe. So we thought $200 million, gives us a good enough $230 million now, gives us enough capital to go after, very good market leaders in LATAM, billion-plus valuation companies. And if the companies are even bigger, we can raise a pipe. We also didn't want to raise a very large SPAC. I think at this point we could have, because it's much easier to kind of go from small to big by adding a pipe, but it's more difficult to do the backwards. So we thought $250 million was like the sweet spot for the target we're going after.
Because, I mean, the SPAC size in many ways determines the profile of the target. So 250 gives you the flexibility if you want to go as low as like $1 billion, but you could still go much higher, you're saying.
Yeah, that's right. That's exactly right.
Got it. So how much does it cost to raise a SPAC, and how does that work? How much capital do you put up at risk, and what's the nature of that capital?
Yeah, it's it's not cheap for for entrepreneurs who are starting it up, and initially, when we were told it used to be roughly 2% of the size of SPAC plus another $2 million. So, it would be roughly, let's say, $6 million for a $200 million SPAC, but that price has gone up a lot. Our SPAC cost is roughly $1 million extra, about $7 million of at-risk capital. I was joking with you earlier. People talk about Bitcoin chart. They should really look at D&O insurance, and the premiums that would have happened there. That's up like I think about 100%. So D&O premiums have gone up a lot, and cost of launching a SPAC has gone up a lot. So it costs us roughly $7 million to do so. I think the other question you asked was also very important. If you're out there very well-established entrepreneurs, you could get most of the at-risk capital from somebody else, and that is easy to do these days, at least for now. But we decided against that. We wanted to have real skin in the game, and more than 50% of the capital have come from the sponsors and the management team, and of course we have other co-sponsors who have supported us in this journey. So, yeah, and by the way, investors really love that. They asked that a question a lot, how much skin in the game you have. And when we told them, they were quite pleased with that because they want to make sure that, this is something that we really believe in. And, our money is where our mouth is, kind of thing.
Right. And the concept here is that this at-risk capital, it's truly at risk. So if you do not consummate a transaction, you lose all of it, right?
Yeah, and I think that's also a big part that people don't understand. They just see SPAC as like, oh, you raise a SPAC, you're just going to make so much money. Well, absolutely not. There's a lot of at-risk capital, which is from us, right? In the SPAC, if you don't consummate a deal, you took 2 years of your life, didn't accomplish that much, and lost $7 million of capital. I think it's very good, to be very honest, that the incentives are aligned. Additionally, when you find a target, you have there's a vote that happens, right, with the public shareholders who invested in your SPAC, and if you don't get majority of the vote, you don't do it. So there's a lot of risk involved for sponsors and co-sponsors in this.
So walk us through that, because obviously the SPAC timeline is a bit different than an IPO. So the first thing you do is you basically you raise the money, you engage bankers and service providers, and at that point, other way around, you raise your at-risk capital, and you work with the bankers and service providers, and then you raise your money in the IPO. But it is a blank check company. So at that point, you now have your investors. But the job is not done then. In fact, actually, that's really when the hard work begins, right?
Yeah, that's right. It is. It's the only time when you're like ringing the bell. You're like, okay, well, now we have to really start working, right? The SPAC rules also allow you that you cannot speak to any potential targets prior to do the IPO. So, you may have a list that you have developed, but you can't have any conversation. So really, the work starts the next day, and you start talking to you kind of start talking to your co-sponsors, your sponsors, reach out to other investors in the region and start talking about your list. Hey, this is what we believe it could be a good target. Why or why not? Are they public, IPO ready? How can we help them? I think this is another part of the entrepreneurial part. Is we want to be at Alpha a value add as sponsors, right? We don't want to just do a transaction and move on. We look at ourselves, including FJ Labs, as very long-term holders of very, very good companies. And for us, we want to be able to be part of these companies for years to come and help them develop with our expertise and how we can help them. So, that's another added part of, tying up yourself with somebody who has a lot of operational expertise, has, grown many, many companies and, mentored many founders in the past. So, yeah. It's the work is just beginning, and it will be fun but learning and probably stressful 2 years.
So to that point, what type of companies make good SPAC targets, and it's not as simple as being, like I am a late stage unicorn, now I'm going public. I mean, there's a lot of preparation that has to take place, right?
Yeah, absolutely. So one of the things that is very important, Jeff, you mentioned that. I mean, they will be it's the way we also look at it is it's almost entrepreneur's dream in LATAM. It's like a fast track to NASDAQ, right?
Yeah.
But that fast track of NASDAQ requires you are, a publicly PCOB ready company, right? Have Sarbanes-Oxley in place. You have several years of audited financials. So it does require a lot of preparation and past preparations for the companies to happen. What else? So that is just the technical part that needs to be there, before you can become a public company in NASDAQ. But additionally, I look at it as, whatever companies make a great investment also make a great spec target, right? It's almost like you want to really fuel these companies with the right founders, right product, with a lot of capital for them to be able to grow. And, hopefully it's going to be a great investment for sponsors as well as existing shareholders.
Yeah. Now, how long, some of the companies in LATAM might not have been built from the get-go for public company readiness. So how long does it typically take for one of these companies to get ready? And does that actually count against the clock? Because remember, you're on the clock when you have to find a target.
Yeah, you're absolutely correct. So it does absolutely count against the clock. You got 2 years to consummate the deal, and it doesn't mean that someone's not publicly company ready and you get another 6 months. So it does count against the clock. We would want to work with companies who have some, structure in place. But one thing about us, if you had to do some added help, we can do it, right? I was a public company CFO for a while. All our sponsors and co-sponsors have public company experience, operating experience, so we can kind of help them, if they're not fully there, help them get there. But yeah, it absolutely does count against the clock. So you would need some kind of scale, some kind of basic things in place for you to be able to do this and do this in a fairly expedited manner.
Now, I think some SPACs, correct me if I'm wrong, they have a provision that you can extend the timeline a little bit if you have like a target in place or you're in talks with target. How does that work? And do you guys have one of those?
Yeah, so that is a good question. From my understanding, how I understood it is you can request one if that's the case of a 6-month extension, and it's rare usually that happens, but that is it exists in many specs, and from my understanding, you can request them. Our hope is it doesn't take that long, and I hope we're going to do it pretty fast. That's the goal.
Yeah. And so the idea is that you would basically get your hands dirty. You would be involved in helping these companies get public ready.
Yeah. That we would be involved as much as they need us involved. We would love to be involved and help as much help as they need, but of course, we wouldn't want to come in the way. But yeah, that is, again, entrepreneur, operator-led SPAC, that is an advantage for target companies, who can pair up with somebody who has experience with this, and we're partners. And I think that's great to have all the incentives aligned together to make you a public company together. I think that works really, really well.
Totally. Now, the other thing is that we actually skipped a step because we just went to actually executing the transaction, but actually negotiating the transaction is really difficult as well, or it can be rather. So what goes into that?
Yeah, so look, I'll talk about one of the advantages of a SPAC for a company, right? And one of the big advantages is certainty, right? The capital's already been raised. So the good thing for a potential target company is, you don't have to go on a roadshow at all for 8 months, 12 months and worry, well, if the market turns, I don't have the capital. Right. The capital's already raised, right? So that's the great part. The other part that goes into this is, of course, the negotiation on price. You have to come to agreement how the capital is going to be used. You have to come to an agreement for that. And additionally, I think it's also very important that you kind of talk about your long-term projection. Another advantage of SPAC, right, Jeff? When a company goes on a roadshow or a traditional route, they can't share their long-term projections, right? And they're more looking at historical projections. So again, for tech companies, I think future is much more important than just the past, right? You really are trying to build something very unique, and being able to just have that discussion with other entrepreneurs who have been in your seat but are now going to be your capital providers. I think that's great. But yeah, the negotiation happens, of course, on price, potential more capital via pipe, and of course, what the capital is going to be used for. How do you want to expand? Maybe it's used for inorganic M&A. Maybe it's used for just expansion in your region. So kind of understanding the full breadth of the use of capital, future plans, and of course price negotiations, which can be pretty heavy.
Yeah, totally. Now, You touched on the pipe a little bit. How important do you think a pipe is to a successful transaction?
Yeah, I mean, look, I mean, to me, or to us, I should say, pipe can be added capital if the company needs it, right? So, let's say if Alpha has decided to go after, or combine with a very large company, maybe it's $5 or $10 billion, $15 billion, of course possible, right? Then you would need at that point, those size companies need more than 230 million capital. So you bring in pipe for that. Look, I think, for us, we can bring a large pipe. By the way, the feedback from investors was really, they are very interested in, kind of co-investing with you. And once you find the right target they agree with, they're very open to having a pipe. But of course, we don't want to. Sometimes having too much capital is not a good thing, right? For a company, and you may misallocate it or misuse it. So I think that's a decision that happens between the SPAC sponsors and, of course, the company talking about, okay, how much capital do you really need, and if you got more capital, can you really fuel your growth in a very sensible manner?
Yeah.
And if they say yes, yeah, sure, we can raise a pipe. We can raise a $500 million pipe or $1 billion pipe. It can be many, many ranges of that. So I don't think it's necessary just to have a pipe, but I think it is another tool in your toolbox that you can use to really help a company grow.
But doesn't a pipe also sometimes help with the certainty of the shareholder vote because it guarantees like committed capital, whereas like a lot of the hedge funds could just redeem, right?
Yeah, so of course, that is a very good point. They can, and of course, if you have some of your SPAC investors also pipe investors, it makes sense because then the incentives are even more aligned. So you're absolutely correct. It does really, really help. Of course, recently we've seen most of the deals go through, but let not past be the predictor of future, right? But yeah, you're absolutely correct. But I think it's the same thing with incentive, right, Jeff? It's if someone who really likes the transaction wants to put in more money, and if they want to put in more money, they want to, of course, see the success of the company. So yeah, you're absolutely correct. It does help, but it helps for the right reason, which is actually really, really great.
Yeah. Now, when executing a pipe, does the sponsor typically put in more at-risk capital?
So I think that's very pipe dependent. To be very honest, when I don't have expertise in something, I will just say I don't. At this point, I'm learning, and I think it could be the case. But since we have not raised a pipe yet, but I don't think it's always the case from my understanding. You can raise a pipe without putting it more at-risk capital since you've already put as sponsors at-risk capital. Potentially, you may have to.
Now, is the typical pipe investor the same as a typical IPO investor? Or are you kind of fishing in different ponds?
It's both. It's both. A very large investor that that Alec and Fabrice has worked with. They have told Alec in the past that they would love to be involved in a pipe. But they're not an IPO investor, right? And they're a very long-term investor, and we would love to have them in your pipe. So they said no IPO, but pipe. But then most of the meetings we had, the investors were like, please call us for the pipe. And then there's, of course, other family offices or money managers who just want to be involved in pipe. So we've seen both. One thing I was very, very pleasantly surprised about was, the IPO investors, one, are very, very interested in a pipe, and second, really want to back good SPAC platforms. They don't, you could tell that, there is some thought process that goes behind this, and they feel that they don't want to just back people who are using SPAC as a trendy platform. They want to really back, people, entrepreneurs, and sponsors who have repeatable patterns of success, because they believe they can apply that repeatable pattern of success into the future using SPAC as a product.
Right. Now, what is the argument for doing the pipe instead of the IPO, and then vice versa?
Right. So look, I mean, the IPO, of course, it's not just an injection of capital, but it's also a liquidity event and making you a public company, right? So if you just wanted to do a private investment, you do a private investment like the traditional VC or late stage growth investors, right? But with the SPAC, you get the capital, but you also get to go public.
Yeah.
And what really, again, I think this really kind of became more and more clear to us. You get to go public with the set of sponsors who understand your future really well, because you can share your future plans. You can talk about, what you want to do in the future. You can talk about you want to go through, a bunch of M&A transactions. That's why you need the capital. So they really are in the right position to value the company correctly versus you going on a roadshow. You don't know who your cap table is going to be in the end of the 8 months if you're going to have the capital.
Right.
And you don't even know if people, well, it's not really invested. You can't really share your long-term prospects because you're not allowed to. So that makes it complicated for high growth companies to, get valued correctly, but also go public. Right. So this is why, we really believe this product can work really well for high growth companies.
And from an investor perspective, if I'm a family office or if I'm in, like a cross and how would I think about investing in the IPO versus the PIPE or other way around?
Yeah. So, very good question, because there's several family offices that, of course, met with us and, connected with us. And they said, we are involved in the region, of course, and we want to be involved in both. Of course, IPO size is small. And of course, there's many, many investors who try to come in. And they're like, when there's a PIPE, please call us and we want to be involved in this, right? So family offices, it's very interesting. That was a learning lesson for me. Very much, focused and want to be involved in, technology companies with very long-term growth profile, on both sides, on the IPO and on the PIPE.
Yeah, that makes sense. Now, one of the concerns I had when I was doing my early digging here is the hedge fund value proposition in the SPAC it's a total no-brainer. It's literally free money. And everything is up and to the right now. And it sounds like most funds are not redeeming, but the first hint of trouble or anything, these hedge funds can redeem and keep the warrants.
Yeah.
And so how do you think about selecting an order book that is truly long-term?
Yeah.
Because these hedge funds might say they are, but are they really?
Yeah. That is such a good question. I think that's so twofold. You're absolutely correct. Some of the incentives have this conflict built in on the investor side. So you got to be really, really picky on who you pick. Get to know investors, right? And this is it's also very important, Jeff. We talked about picking partners, picking the right partners, such as banks who can guide you and tell you this hedge fund, it's a family office, but they're involved in a lot of pipes. They are investing in a lot of pipes versus a hedge fund who's not. Getting to know your investors, I think, is really, really important. Picking that essentially your IPO investors, which is going to end up becoming a cap table in this big other investment that you guys are making. I think it's very, very important to do that. The other thing is, I think the SPAC market is evolving and is going to continue to evolve in positive way, right? So a couple examples on that. One is, you saw, I don't know if you got a chance to look into Bill Ackman's SPAC structure, right? It was very, very interesting. Essentially, if you redeem yourself out, you get significantly less warrants. I think it's like 1/8 or something like that. Versus if you say yes, you get to keep your warrants. So this is a very interesting structure. And the other thing about that SPAC, which I think is very interesting, is you do kind of an earn-out over a period of time after you meet certain targets of growth with the combined company. It's a very, very long-term option. So I think SPACs are going to evolve in this way in a very positive manner to make sure incentives are even more aligned, because I think this is a great example to disincentivize people from not just trying to use this for free warrants, because you significantly get less warrants. That's one thing. I think the second thing is the SPAC market has it's good and bad. Of course, it's taken off, and sometimes it feels like it's taken off really fast. The amount of warrants that are going out have reduced. So in November, when we started, roughly 50% of SPACs launched had at least half a warrant per share or more. And now that number's 30, right? So the dilution, the SPAC market's tightening up quite a bit. So the incentives for people to just come in for warrants is reducing as the number of warrants reduce overall.
That's interesting, and I think that is just a testament to how insanely hot the SPAC market is right now. But I knew about the unique incentive structure for the sponsor for the Bill Ackman, the Pershing Square Tontine Holdings, but I did not know about that warrant provision.
Yeah.
You might not know the answer to this, but why don't more SPACs basically penalize those who redeem?
Yeah, look, I think that's going to happen, Jeff. I mean, I think it's a period of time is going to happen, but there's a lot of first-time sponsors, right? And you're just entering the market, and not a lot of you have not established yourself as a, a, a great user of the SPAC platform as a product, right? I think, I really believe this. There is going to be tiering in the SPAC sponsor market. I think just like there is in banks, right? You have tier one banks, tier two banks, right? And I think tier one companies eventually are going to want to partner with tier one sponsors. And eventually tier one sponsors, based on the historical performance, are going to do that. I do believe, I think it's going to involve, I think the right-minded investors in the long term, they're going to make sure that it evolves in this direction. Yeah, I think that's going to happen.
Actually, I mean, I think there have been a number of SPACs now which actually have issued minimal or no warrant coverage, right?
Yeah, I mean, I've seen 1/5, 1/8. I think there's so many SPACs, it's hard to keep up these days.
Yeah.
But I do believe I have seen 1/8 too, so I wouldn't be surprised if there's no warrants at all.
Yeah.
Absolutely.
Now, in a case where you have minimal or no warrant coverage, is that the case for the sponsor as well, or is that only basically what you're giving new investors?
Yeah, so your warrant costs. I love this podcast because it's great to talk about all these details that people don't know, right? I mean, I think it's really important to tell the audience. What happens, Jeff, is sponsors' cost for warrant also goes up. So let's say traditionally the way market works is, you put 7 million at risk capital, you get 7 million warrants as a sponsor. Investor get half a warrant for every share they buy.
And by the way, what you're saying is that you're basically the 7 million in at-risk capital. You're buying the warrants. You're getting the founder shares for a nominal cost, basically for
Correct.
25,000. I think.
Correct.
Right? Typically.
Correct. Yeah. That's right. You get the founder shares at very nominal, $25,000. Plus, then you invest the 7 million, you get warrants for it, right? Now, in a situation when there's 1/8 of warrant, you could have a warrant price for $4. So instead of getting 1-for-1 as a sponsor, you may get essentially half the amount of warrants, right? So it's tightening on both sides to make sure the incentives are again aligned. Or you may say, I am going to get essentially instead of getting 7 million warrants, I'm going to get 1 million warrant, right? So there is significantly less dilution on both sides.
Oh, so the warrant coverage is equal across the sponsors and the investors. So minimal warrant coverage for investors also means minimal warrant coverage for sponsors.
Correct. The warrant ratio for sponsors changes significantly. I have not seen the price of sponsor for 1/8 what the price ends up being, but for example, it's very prevalent in the market when you're down to 1/4 warrant per share. Your warrant price for sponsor doubles as well, since you're getting half the amount of warrants. So yeah,
interesting.
It is. So
because I always was under the impression that the warrants that are issued are basically like an investor sweetener, but it sounds like it's not that simple because the sponsor is also getting less.
Correct.
So
Correct. If you're going to give investors less, sponsors should also get less to kind of have this incentive aligned. Yeah.
But what that means effectively is fewer warrants is less dilution in the end, right?
Correct. I mean, so let's say if you had 1/8, instead of 1/2 on a $20 million on a $200 million SPAC, you're going to have, I think, 1 million, maybe 1.25 million warrants outstanding. Plus, instead of then 7 million on the sponsor side, you're going to have maybe 3 or 4. So suddenly, you've reduced the amount of warrants by 10 million, some large amount, right?
Right.
And that's great. And that's great for all parties involved.
Yeah, that's interesting. Now, I think that's also a negotiating point with the companies, right? Because the target companies are likely going to want to negotiate dilution because SPACs can be quite dilutive. So Is that one of the levers that you pull? Like, what are the different negotiation levers?
Yeah, so I think that's a great question. I think very situation dependent. I have seen, I have heard, not particularly seen myself, but speaking to different experts in the market, you can do earnouts of like longer lockups. You can do hitting certain thresholds. Jeff, you can do a large pipe, right? If you had a $200 million SPAC and you did a $1 billion pipe for a $10+ billion company, your dilution is essentially non-existent.
Because the pipe doesn't have the same like 20-25% dilution, right?
Exactly, right. So you suddenly have gone from a warrant structure which is only part of 200 million to have $1 billion that has no no dilution. So then combined, it becomes maybe 4 or 5%, maybe 3-4%, right? And then of course you combine that with the company, it becomes very insignificant. So that is one more advantage, of having a pipe. It really helps. It really helps with the dilution part. And the other thing is, that's another reason to do a lower SPAC IPO, right? Clearly, if you just want to do everything for money, which is not the right incentives, you can do a very large SPAC. But the smart sponsors, what they're doing is a good enough SPAC to kind of have the right target. But if you want to do a larger company, you can then add a pipe versus kind of going backwards, which you can't do.
And that's why, totally. And that's why I found that I think the typical pipe to SPAC ratio is like 2 to 1, or it's at least 1 to 1 for like to minimize the dilution that takes place due to this.
Yeah, and I think it's going to change. I think the good sponsors, my view, Jeff, is like tier 1 sponsors. I think they're going to change the ratio even more. I think they're just going to use this SPAC vehicle as a vehicle to go public and capital, but then they can bring in a lot more capital, on top as a pipe. So it's better for everybody involved instead of just doing a very large SPAC and giving away flexibility. Continue to do these same sizes, but then add a lot of pipe.
Well, ostensibly, you as a SPAC sponsor, you want the largest SPAC possible because you get the founder shares. So like if you basically have to already have a lot of money or see like a path to making a lot of money in the investment if you're going to do a really large pipe and a really small SPAC, because the pipe doesn't actually drive any value to the sponsor, right?
Yeah, it doesn't, right? In general, it doesn't. If it does, it's probably very, very small or something like that, right? But in general, Jens, you're correct. You're absolutely correct. And I think this is why I think you will have tiering in sponsors, right?
Yeah.
I think tier 1 sponsors are going to think very long term as a SPAC, as a product for their platform to build very good reputation. Not just on the investor side, but also on the target company side, right? Doing all the things the right way, thinking very long term.
Yeah.
What's best for the company, and being able to do this, 10, 20, 30 times as a platform versus like, oh, let me just raise a big SPAC and make money. I think that is also going to be a differentiating factor, in good sponsors versus not good sponsors.
Totally. Now, to that point, it's SPAC Mania at the moment in the US. From everything I've read, the typical SPAC is getting like, first of all, you're seeing SPACs which are going public at $10 a share, pre any notion of a target. They're trading at like $14, $15. I mean, Churchill 4 traded at $50 a share, a 5 times markup before they even announced the target. I think it might have even went higher than 50. So there's like unbelievable appetite for SPACs at the moment. Yeah. And in fact, from what I've read, we're on track. Sorry if there's some background noise here. We're on track to see north of 1,000 SPACs this year, when this is like dwarfing any previous year. And so what I'm trying to understand is like what are the natural next steps here, and like how much appetite can there be for such a product?
Yeah, I think that's a great question. I also have been thinking a lot of like why SPACs really just took off. This product has been around for a long time. It's not a new product, but why did it just take off last year? And I think there's like a certain set of perfect circumstances that happened last year that really helped take the product off. I think it's good to talk about that really quickly. One of the things SPACs really do is take away uncertainty, right, of capital, because you already have the capital ready, and all you have to do is a one-on-one negotiation with the sponsors, right? So if it takes away uncertainty during very certain times, it's not as appealing, right? Before COVID, things were pretty certain. Market was low volatility, markets were open, so it's not as appealing. Now suddenly you add COVID, but things become so uncertain. You're a high growth tech company, and you're like, okay, well, can I even raise money? Can I even go on a roadshow? So suddenly SPAC as a product seems very appealing. You're like, okay, wow, it takes away all the uncertainty, especially in this uncertain times. It's a very certain product. Then you add that with some really smart sponsors. Before you didn't have as many great names. Now you saw some really great investors seeing that opportunity, saying, "Oh wow, this is going to be a great product for this time because it takes away uncertainty. It's very certain." So then they started, being involved, and I think some of these great sponsors that came into this market did a great job communicating the benefits. By the way, I think it's very important to market a product correctly, and I think you got some really smart tech investors who started communicating the benefits of this product really, really well. I think that was also great. I think you combine both of these things and then you add negative real interest rates as like high octane fuel to this product because it's really well suited for high growth companies, right? Then SPACs really took off. I think the right circumstances happened last year to really make this product big in a big way. Where does it stop? I again think there's going to be tiering. It's with great product, there's always comes some misuse, right? And I think I don't want to call the word misuse. I think there is it feels too many SPACs. I understand without so many targets out there, so it feels like too much. I think there's going to be tiering. I think the good platforms with very good track records will really be tiering themselves, and some of the ones that have just raised the SPAC is to make some quick money. I think those are not going to be existent in the future. It's my view.
Yeah, it totally makes sense. I've been thinking about this a lot myself, and what comes to mind for me is right now, first of all, from a sponsor perspective, it's just a fantastic product. If you think about it, someone tweeted today, how is a SoftBank Vision Fund going to compete with SPACs? And it's actually interesting because if you think about it, in many ways, that is what the alternative is. You're competing against these massive growth equity funds like the Vision Fund. You're writing similar checks, but you're also promising public markets. Yeah. So that's one angle. But then the other angle, if you're a SPAC sponsor like a Chamath, you're effectively raising like SPVs with deal by deal carry. Yeah. So you don't have to raise a traditional fund and have a diversified portfolio of investments. You get paid independently in every single one. Yeah. But and I think the reason, first of all, I think interest rates and the stock market euphoria are driving this. But then I also think what could happen next is we have such a glut of SPACs in the US right now that I think you're going to see. It might take a little while because they have this 2-year mandate, but maybe towards the end of this 2 years, you start to see SPACs that can't find targets, or they bring really like trash targets to market, and then the market stops absorbing all of these. And I think at that point, first of all, you'll see sponsors getting burned, potentially losing their at-risk capital, lose like the reputational risk. Yeah. And frankly, what I'm concerned about is you're seeing it's almost like the Wild West. You might see a regulatory crackdown when the retail investor who the topic of who I said last podcast is basically the one who's going to get burned. When undoubtedly they do get burned, you're going to see regulators step in and try to come up with a way to protect the Joe Schmo who's getting burned.
Yeah. By the way, I agree with you. Made several different points in that, like Vision Fund versus a SPAC, using this as a vehicle to get, individual carry instead of raising a traditional fund. And then, of course, what happens in the next 2 years because there's all this capital out there, right? 100% agree with all of them, all of these points. And I think it is going to be an interesting 2 years of what happens. I think every product or, when something new happens, there is some like misuse, right? Or a period of time, market corrects itself. And then people are like, okay, these guys used it very smartly. These guys didn't. I absolutely do think that's going to happen in the next 2 years. It's going to be very interesting to see if you can find the right target that can actually add value to investors versus just a target because 2 years are up. I agree with you. I think there is going to be a lot of up and down in this product. I think the product's here to stay, but there will be a lot of up and down in this product, Jeff. I 100% agree with you.
Yeah, and I actually totally agree with you that I think there will be tiering and that the elite like SPACs are here to stay. It's interesting. I don't know if you saw this. Charlie Munger came out yesterday. For those who don't know, the Berkshire Hathaway co-founder and legend, saying the world would be better off without SPACs, and that they could signal an irritating bubble, and that pardon my French, investment bankers could sell shit until there's no demand for shit or something like that. So. It's interesting, and I mean, in some ways, I share the sentiment. But like the conclusion of my last podcast was actually this is a really promising vehicle that is here to stay. But how does this tiering take place? How does this differentiation take place? Is it basically just the results?
Yeah. I think, Richard. By the way, I think it's hard to generalize, right? Because I sympathize with Charlie Munger's words, of course, a brilliant investor of our time, and but I think it's hard to generalize because it's not going to be true in all respects. But I sympathize because you do see, let's just be honest, you're seeing SPACs being raised by banks, sponsored by banks, underwritten by banks, with nobody from outside, right? And that's not good. I mean, I don't think that's good, right? I mean, that's just essentially a vehicle to make more money for a bank. That's the problem. I think people are going to misuse it, and then they will eventually go away. I think it will take a couple of years, though, right? Because how do you measure a good tier one sponsors? It's through success. But success takes some time to play out, right? And especially with high growth companies, they have a lot of ups and downs. And I think that's going to take some time. I think it's going to be a couple years, 2-3 years before market really starts differentiating true good sponsors by performance of their investments that they've combined with, versus just now that SPAC prices, like you said, if it's a well-known sponsor, I don't know if that sponsor's added value or not, can double without even a target, right? That is, I think that is, a Spac Mania type situation. I think over a period of time through results and investment records, I think people will be able to differentiate themselves.
Yeah, the issue is there's a bit of a feedback, like a delayed feedback cycle here because you have that 2-year period. So I just wonder out loud, can the market sustain 1,000 new SPACs this year? Is that possible? I mean, is there that much appetite? Like, imagine the typical SPAC is what, 200 million?
Yeah.
I mean, we're talking $200 billion worth of SPACs potentially.
Yeah, I mean, it's roughly, we're doing 4 to 5 SPACs a day in the last month, and it's like 7 to 8 billion a week, right? So it is pretty crazy. But yeah, I don't know. I don't know the answer to that. I think there is going to be indigestion, right? There was indigestion, by the way, in late October, early November, when suddenly all the warrant coverages went out. I don't know if you recall this or not. There were SPACs that were actually adding interest in the vehicle to be able to attract investors. Meaning, let's say you're supposed to invest in treasuries, you get 5-10 basis points. They were actually guaranteeing a 50 basis point return on a $200 million SPAC. That means they're putting $1 million more to investors to be able to earn that, to attract capital, right? So markets can turn pretty quickly.
Does that come out of at-risk capital?
No, on top. So to attract capital, they said,
so that's basically more dilution when the merger takes place.
It's more at-risk capital yes, you're right. So they will get some more warrants, but the money goes to the investors who come into the IPO. So it's not a great thing, right? And people are putting in more money just to attract. And that happened pretty fast in October, November. And I think, there will be, there can be indigestion. It can happen fast.
Was that what you would consider like elite managers, tier one managers?
No, it was
okay.
definitely like.
So this could actually paint the picture for what could happen. You could start to happen.
Yeah.
But presumably, if you're like Churchill or Gores or Chamath or one of these like hot names, this is not going to be an issue for you.
Yeah, I don't, of course they have established themselves very well. I don't think so. But yeah, you may get all these second and tier get washed out because they just don't have the demand and they have to put in so much more money to get the demand, which itself is so dilutive, just the whole thing goes away. So I could definitely, and the market will determine tiering over a period of time.
Yeah, that's really interesting. Quick time check. I can go till 1:30. How long can you go till? And Fabrice can as well.
I have all this time.
I mean, I'm having a great time. I think this is fascinating.
Thank you.
So now, actually, one of the things we should talk about is this increased competition. Are we starting to see this lead to a compression in economics on the back end? Because I think a lot of targets are hiring investment banks to basically run like the merger process on their end. So it almost turns into like an auction, right? At least in the U.S.
Yeah, and I think this is, and again, I think it will turn into, to your other point, if you're raising capital at this rate, 7-8 billion a week, right? What happens? I mean, there's especially just very U.S. focused SPACs. What happens? Eventually, you'll get this auction process, right? And I think that's just terrible for investors, for SPAC investors over a period of time, right? So yeah, I think that can happen. And I heard this was happening. I watched another video from Barry Sternlicht, and he was talking about that in U.S. in November. It was already happening, where people were saying, here's the valuation. Now you bid me a promote structure going to 4 SPACs. And I think that's not the purpose of this, right? I mean, we at least are at Alpha SPAC and, together with you guys, we look at this as we want to solve a problem, where there's lack of capital in a very high growth area, great entrepreneurs, great GDP per capita, great internet. And we want to solve a problem because all of LATAM had roughly 10 billion invested in tech companies over 5 years. We're talking about 7.5 billion a week in US, right? So, and this is where the value add comes, right? As entrepreneurs in that region, respected entrepreneurs in that region, Fabrice, Jose, Rafael, and of course Alec, we don't want to be involved in things like that. And I think
Totally.
That is why it's very important to go after a problem to solve versus just say, okay, I want to raise a SPAC because it's very cool and I'm an athlete, I want to raise a SPAC. And I don't think that's not using the product correctly. I think you're not solving a problem.
Yeah, totally. And I, by the way, feel the same way. I think the LATAM opportunity is incredible. That's why we're so excited to be partnering with you guys here. And I think that in the US, you are seeing Paul Ryan, the politician, like athletes, like Joe Schmo is raising a generic SPAC. You're competing against literally hundreds of others.
Yep.
And by the way, it's not just hundreds of others. You're competing against the entire existing ecosystem of late stage investors, private equity, growth funds. So it's like, to me, I mean, frankly, well, let me ask you this question: Who does this benefit? The hypersaturation in the U.S. of SPACs?
So few. I mean, of course, few people. It's my guess, top of my head. And I'd like to hear your answer on this too, by the way.
I have some thoughts. Yeah.
One, banks, right? Of course, you're collecting fees up front. All the service providers around it definitely benefits because you're collecting fees regardless. It definitely benefits them. I think private companies, private late stage companies. I mean, if you have so much capital coming after you where you can say, bid me a price and bid me a promote and go into an auction process. I mean, the item that's getting auctioned is the winner, right? Or whoever.
What do you mean by bid me a promote? Can you explain that?
So think of it this way. You got 4 SPACs reaching out to you and you're like, okay, well, I want my valuation to be 10 billion. Making up a number, and 3 of them agree. 4th one drops out, and then there's 3 left, and you're like, okay, well, bid me a promote structure. What % of promote you're going to cancel, and what percentage of options you're going to cancel, and then let's see if I merge with you, right? I mean, that's that is not. It's just an auction process, and it's going to cause very, very high valuations without any value add, right? Because then what's the value add?
Yeah.
So I think
Couldn't one of the SPACs just say, well, I'll give you a $12 billion valuation and keep their existing structure?
You absolutely can, right? And I think this is again, the beneficiary. One of the beneficiaries is going to be private companies, and of course a lot of service providers around, right? They will collect a lot of fees. Now I want to hear your views on this. Who do you think are the beneficiaries of this?
I think the beneficiaries are venture funds. I think we talked about this a little bit on our last podcast, but I think that a number of the companies in our portfolio, which one might consider like not the studs, not the incredible companies, are the ones getting SPAC'd, are getting this capital that they wouldn't otherwise get, and then are getting support in the public markets. And so I think if you have, I've seen funds, particularly in deep tech and frontier tech, they're getting many portfolio companies SPAC'd, and the multiples that their marks are just through the roof. Yeah. I mean, it's unbelievable. And these are and just given the demand from SPACs, these are not the Coinbases that can go public by direct listing or the Spotify. These are like, a lot of them are pre-revenue frontier tech companies. I mean, This is a cool company, but Joby Aviation, which is this flying car company, is getting taken public by Reid Hoffman's SPAC for $6.6 billion. And like, that's awesome and all, and maybe, who else might be the beneficiary in some ways? Society, because you have this like capital going towards these frontier tech projects, perhaps accelerating some of the innovation that might be taking place.
That's a very good way to look at it, Jeff. I mean, there is definitely. I mean, so I agree. Existing companies and existing private companies and their current investors, big winners. You're right, but I think the society part is actually quite interesting.
Maybe I'm being too optimistic. I don't know.
No, but I think there's something to it, right? I mean, if you throw a lot of capital at a lot of problems, maybe 9 out of 10 fail, but 1 out of 10 that may not fail could really be like an exponential grower. you hope to be investors in 1 out of 10 and not a 9 out of 10. And, the ratios of investors not great, but I think that there's something to that. I never thought
Well,
about it that
I
way,
think
but that's pretty cool, actually.
I think that's an
Interesting way
argument
to
in
look at it.
favor of like frontier tech investing in general, and like I think that the soft banks and specifically frontier tech like Founders Fund, Locks, DCVC, like they're taking great risk with their capital. They're trying to make money, but the outcome is that they're funding R&D that might not otherwise get funded. The issue with the SPAC element is that at the end you're dumping these companies on the public, and then you have the quote unquote retail bros who end up investing in the like weird flying car companies or like the synthetic meat companies, and they're the ones kind of potentially getting dumped on.
Yeah. I think one thing people have also not realized, Jeff, on this, these companies with really long-term cash flows and, kind of like the frontier tech, and it's like barely any revenues, right? It's a really big idea, low probability, but high impact idea. They're going to be public companies and their results are going to be all over the place, right? Because they don't have a product yet, a full product that's commercialized, right? Many of them are like that.
Yeah.
That causes a lot of volatility because you have, as a CEO, have to come out, do quarterly results. And, how do you guide investors? I guess you can't really guide them so much because it's going to be tough. It's going to cause a lot of volatility, because these companies, by definition, frontier tech, are like, they're volatile. And now they're public market entities, right? So that can be kind of complicated in the future.
I mean, and there's almost a philosophical question. Like one of the companies that I singled out in my last podcast was QuantumScape, which is it's pre-revenue. It's trading at 60 billion. It's a battery tech company for electric cars, and they're trading it. It was at its peak trading at $60 billion. It doesn't expect to see revenue for 3+ years. Now, should that be a public company? I mean, on one hand, I think we should be giving investors, like American investors, the chance to invest in amazing futuristic companies. On the other hand, there's a very slim probability of success here, let alone the company reaching sizable revenue, let alone earning a $60 billion valuation.
Yeah.
I mean, where do you draw the line? Like, should we be quote unquote dumping these companies like in droves onto the public? I don't know.
Yeah, I don't know. I don't know. It almost seems like a, very early stage biotech company, right? Where you don't have like a cure for, you're using, high technology to fix have a cure. But I mean, it's very volatile, right?
Yeah.
And, how do you value that? And should regular investors who are not ready for this, should they own it?
Yeah. In many ways, like we have this private market ecosystem to kind of de-risk these businesses and like fund the science risk. And now we're taking businesses, we're basically skipping the whole private ecosystem, the private market cycle. And we're just kind of like, here you go.
Yeah.
Here's like a business. It's a science project, but here, $10 billion valuation.
Yeah, I think that's a very interesting point. It's going to be interesting few years with especially these pre-revenue, very large, where technology is not even fully commercialized, and they're a public company.
Not even fully commercialized. Like not even like the technology is not even there. I mean, some of them are crazy. I mean, and that's the concern for me is like, remember Nikola, which is like the electric truck company, which is effectively a fraud. And they are, I believe they're still trading at a multi-billion-dollar valuation. And like you have these retail investors, almost a lot of whom expect if a company is public that there's been some level of diligence done. So I worry that's where the regulators might step in.
Yeah, you're absolutely right. Just because it's public doesn't mean you can't lose all your investment. I mean, it's an investment, and it depends on the company and how they do. I mean, again, I think the next 2 years, especially with these, SPAC vehicles, I think it's going to be a big differentiator to see which sponsors really thought about all this before they took the vehicle public, or they just took it public. And I think that's going to be part of the tiering. It's some ideas, like you said, there's this private capital out there to fund this part of a company's life cycle. You're skipping that life cycle and making it public. Is that necessarily a good decision? I don't know. Yeah.
And actually, I think early stage venture, particularly frontier tech venture, is a massive beneficiary, at least for now. Because remember, when unless there's a secondary transaction that takes place as part of the IPO, and my understanding is that's not usually the case, at least in tech, when these companies like need the money.
Yeah.
I think that it gives you a nice mark to like raise a fund or two from your investors, but then can these businesses be sustained in the public markets? So for now, the answer is yes, but like, should we have a correction or I mean, I don't think Nikola and QuantumScape and all these other frontier tech businesses will sustain the crazy high valuations. And then, I mean, then you're a VC in this public company, but you're kind of stuck in there. You have the lockup period. You might have like liquidity. So
yeah. And I wonder if some of these companies will do a second round. I mean, Open Door, of course, went public, then had a pretty large pipe, but they then just issued, I think 28 million shares or something like that at roughly $27.
exactly, yeah.
So, they raised another over $1 billion or something like, right out. I mean, and they just went public, right? So, because
by the way, if I were QuantumScape, I would raise as much money as I can
at these valuations, right? Yeah,
exactly. I mean, they went public at 10 a share, which a lot of people thought was inflated. Then it was trading at like what, 80. So why not raise, to your point? Like, because these high prices can actually change the potential future path of these businesses.
Yeah, and I mean, especially at these valuations, you're absolutely correct. I mean, I wouldn't be surprised if some of these SPACs who have gone public without much revenue, really, like I said, no commercial technology, and has gone up 40, 50, 100, 200, 300%, are they going to raise more capital? And maybe that is what gives indigestion to the market, not just the SPACs, but same companies raising more capital 6 or 12 months after just going public.
Yeah. Although from the company perspective, that's certainly what I would do.
It is. I absolutely agree, as they should. And it becomes so much massive supply, not just a SPAC, but existing SPAC companies raising more capital on top.
Yeah, for sure. So we have a couple of audience questions. Let's see if I can read some and we could see if we can answer them. So we have a question from Jonathan. He says, how much of the at-risk capital can you defer payments on?
So for the at-risk capital, you can't defer payments on anything. What's deferred is essentially, so there's a 5.5% charge when you raise the vehicle, right? The 3.5% when you consummate with the company. If you don't consummate with the company, that is kind of not there. So the $7 million that I gave example is pretty much going to be all used in the next 2 years. It's not really, there's not much deferred to it. You're going to use it for due diligence. You're going to use it for legal fees. You're going to use it for audit purposes. You're going to pay of course, the banks, etc. So all that $7 million is used upfront, essentially over a period of 2 years. Yeah.
Right. And by the way, you have to create a budget, and you're like, it's like running a little, it's like running a little company, right?
Yeah, I remember you and I had this discussion, and you were like asking me so many. By the way, you asked so many detailed questions. I remember this in December, and I was like, I have this model.
Yeah, like, well, I mean, it's not as simple as it looks.
Yeah,
like,
no,
it's built. I mean, it's different if you're like a franchise, like a Dragoneer, and you already have like a existing infrastructure in place.
Agreed.
But otherwise, you have to build a little startup. And so, yeah.
It's a startup which is using SPAC as a product. You absolutely have a monthly budget of, office costs, $700, or like if we have to travel, how much can we allocate to travel? Yeah, it is. Yeah. And it's all our money together, right? Exactly. Ours at FJ Labs, Alec, Rafa, myself. So you're actually really cognizant with costs as well, which is again a good incentive alignment to make sure you want to invest in sponsors. They're putting their own money in.
Yeah, of course, totally. So Henry asked a question. So is there a lock-in for those pre-revenue IPOs?
Pre-revenue IPOs.
So I think the question is basically here's my perspective. How do you prevent people just dumping the shares? Like, what's the lockup period look like for SPACs?
Oh yeah, so founder shares have a lockup period of at least 6 months, up to 12 months, depending on performance. So if your performance is over a certain amount after combination, you have 6 months. If not, you have 12 months of lockup. So founders, sponsors have lockups. Additionally, I have seen lockups being negotiated to even more to say further align incentives if needed. But yes, at least 6 months, up to 12 months.
Now that's 6 months from the actual merger taking place?
Correct. From the merger taking place. So if I think every SPAC is different. And I recommend everyone reads the S1s if they invest in a SPAC. the traditional one is, I believe it's 12.50. If the price of the shares are over 12.50 after combination of 20 trading days, then it's like 5 months. But it's 5 months plus 20 days ends up being 6 months.
Sure. Yeah. So the truth is that you can get out something like, given the way things have been trading, given the average SPAC, I believe, is trading north of 12.50, you can probably get out 5 months after the date of the merger.
Yeah, you can. I think that's another thing that's going to differentiate good sponsors, right? You will see, I think, over a period of time, tier one guys are not going to sell. They're not going to sell their shares. I mean, I was listening to our interview with Chamath. I think he said maybe one company out of all the investments he has done, he has sold something, and I think they needed it for liquidity purposes.
Yeah, I think he was
at his family office.
Virgin Galactic. Yeah, I remember.
Yeah.
There was a big kind of like a controversy that he like sold some of his Virgin Galactic at lockup. But you're right. I mean, I guess he's holding most, if not all.
Yeah. And I think that's going to be a differentiating factor. I mean, of course, everyone can sell a little to be able to take that money and do another SPAC if they're tight on capital. But I think that is going to be one more point that people will look at, saying, did this SPAC company perform from this sponsor, and were they long-term holders, or have they just sold after 6 months?
Or is it a get-rich-quick scheme, effectively?
Yeah, exactly. Yep.
So Matt asked the question, guys, clarify the initial IPO dollars, such as the 230 today. Is there a virtual roadshow? How is the allocation made, etc.?
Yeah, so there's a virtual roadshow, call it testing the water meetings, meet several investors and kind of essentially, you're presenting, the sponsors and their idea and their, repeatable patterns of success. I hope that's what investors look at, really. All investors should look at and say, okay, well, we believe in the sponsors. And then, of course, during the allocation process, you work with the banks. You also work with, we were very selective on the investors we picked as a combination of, people who believe in the region, people who have, want to be invested in us with PIPE, long-term investors, et cetera, et cetera. So yeah, you get to work with the bank to pick your investors.
Is there an ideal number of investors in an IPO?
Yeah, no, I don't believe so. I mean, there's definitely some, retail allocation as well, and there retail investors get some allocation as well. But I don't know if there's a ideal number. But you kind of want 80-90% to be held by, I would say 15-20 type investors, right? Who are going to be partners with you for time to come.
Sure. Okay. Ram asks, can you please throw some light on technical parts like warrants also? So I think we touched on the warrants, but maybe we can talk about the fact, is the money that you're using to buy the warrants, is that just like a mechanic, or is that actually important? And what I'm saying in the beginning, remember that $7 million is technically used to buy the warrants.
Yeah, it's just a mechanic, I would say. $7 million is, of course, used to, form your company, pay listing fees, pay SEC fees, pay legal firms, pay the banks, right? You're using all that capital as a sponsor to kind of get your SPAC up and running and actually go IPO. But yeah, it's more of a technical, thing. And I think there is one thing I think we covered, which is very good. There's a ratio between how many warrants an IPO investor gets and how many warrants does the sponsor get, right? So if the IPO investor gets less, the sponsor also gets less, which is, I think, good for people to know. It's on both sides.
The other lever that you can pull is not only the number, the percentage of warrant coverage, but also the price per warrant, right?
Yeah, exactly. So if you're doing 1/8 for public investors, then your price for warrant maybe $3 instead of $1, and then of course, let's just say $3.50 instead of $7, instead of $1, you're getting 2 million warrants instead of 7 million warrants, right? So significantly reduced on both sides. But that it's more of a technical thing, like you said.
Yeah, but the key thing there, which was, I guess, my big learning today, was that no matter what, the investor and the sponsor pay that same dollar price. So, I mean, right? I think
they don't pay the same dollar price, but they tighten together. So the ratio. So
okay.
It's not just you're giving public investor less warrants; you're also taking less warrants, and now that has to be an agreement of, is the price $2 or $4 if you're going at 1/8 warrant. I think that's a discussion you have at like understanding the public markets. But yeah, it's tightened on both sides. I think that's the key part.
Got it. Okay, understood. Wada asks, thoughts on current bond yields on SPACs? It's a good question.
Yeah, it's 2 basis points because with SPACs legally can only purchase treasury or treasury related maturities, which is 184 days or less in maturity. Yeah, that pays 2 basis points annually. So.
But I think what he meant is the fact that bond yields are so low in general is that inflating the SPAC bubble.
Yeah, I think the money is, the cost of capital is very low, right? And it does. I think it values especially high growth companies. So let's think about 2 factors in SPACs. One is you can share these future cash flows that you can't traditionally. And high growth companies, these future cash flows are worth a lot, but you could do it with the SPACs. The SPAC are more inclined towards going after these high growth companies. So if that's the case, and then you have negative real yields, it kind of really works in favor of SPACs, right? Because they're the ones at the right place to value high growth companies. So it does have a big impact. I mean, I think negative real yields have been like a high octane fuel to SPACs.
But actually, that's something we didn't talk about, which is okay. So imagine bond yields start rising. What does that do to SPACs?
Yeah, I think all risky long-term, long-tail cash flow products will be impacted. I really believe that. I read Fabrice's piece on everything's bubble. I think it's called Everything Bubble.
Yeah.
And I thought that was really, really good, especially, and I think you've seen it, right? I mean, bond yields have essentially almost doubled in the last 5 months or 6 months. Because you're seeing if once the economy opens and there's all this stimulus, and there was a very good waterfall in that newsletter talking about all the savings rate, right, that has gone up, and now you're going to add more of its stimulus. And you're seeing the impact especially in the last 2 weeks. I think bond yields are up almost 40, 50 basis points.
Past a couple of days even. Yeah.
Yeah. So I of course the discounting mechanism changed, and I think every long tail high risk product gets impacted.
Yeah. Henry asks, do you guys anticipate European exchanges being used for SPACs like Kazoo planned to?
Yeah, that is interesting. I am not as familiar with European exchanges, but I don't see a reason why not. I do, however, also always believe that U.S. capital markets are the most liquid capital markets and very well regulated in the terms of public companies, right? So more and more startups or technology or high growth companies want to be listed in U.S. And they are more so. We called ourselves a fast track to NASDAQ. For LATAM companies, I think more companies will be inclined to go towards that, but I don't see why not. I've not looked into regulations in Europe for SPACs myself, but I don't see a reason why it wouldn't be.
It's interesting. I can't comment on Europe, but I can tell you. Regarding Latin America, we've had 2 very successful Brazilian IPOs recently, and I'm sure more to come. Do you feel that the hot Brazilian stock market might almost be a competitor for you guys?
Yeah, I think the larger, the IPOs that have happened, and I've not seen in the last couple weeks, but have been more on smaller side. Several $100 million versus high tech growth companies, in the $1 billion, $2 billion, $3 billion range. I think the market there is not, ready for those kind of high growth tech companies with potentially negative no EBITDA high. I don't think those local markets are ready for that yet. I think higher value, bigger companies are still going to incline to be in U.S. because they're more developed markets.
Yeah.
More liquid.
Yeah. So and we are seeing the best-in-class Latin American companies going public in the U.S.
Yeah, which makes sense. Very liquid markets, right? And then you can, of course, as companies grow, become multi-billion-dollar revenue companies. They issue convertible bonds. They can use debt, right? And U.S. markets are very, very liquid for that.
Yeah. Skippity asks, how about a SPAC rolling up 2 companies, one with high earnings in an industry with low PE multiples, and the other in a high multiple space?
Yeah. That's a good question. I don't fully know the right technical answers, but I believe the way it can be done is the 2 companies have to merge and then merge into a SPAC, because SPACs are built for one public company. So they would have to do a merger deal and then use SPAC as a vehicle to go public. They can. I mean, sure. By the way, I think there's a company, investment management company. I forget. I think it's Owl Rock or someone like that. Dial Capital, which has stakes in. I don't know the company name of the stakes in different stakes as into GPs of different investment firms. I think they're combining two and trying to use SPAC as a vehicle to go public. But yeah, I think you have to combine them first, from my understanding. Yeah.
I think I saw recently an example of a SPAC which is able to use like a portion of its proceeds to do a second transaction. So there's starting to be some innovation, or maybe you call it financial engineering, to try to basically take two different companies public, which is kind of crazy to me.
So do a transaction to first merge couple companies, or just like take one public and
like literally you use 75% of your proceeds to take public one company and then another one. I think it's Spinning Eagle or something like that. One of those, something Eagle.
That's interesting. I will have to look. I'm going to make a note. I'll have to look into this. But I bet the way they did it was like a combined transaction of merge these two and then take them as a combined company public. 25% used for one, 75 for one. To combine them and then take it. Maybe it's like a one piece with different steps transaction. I'm going to look it up.
Yeah, I'm curious too.
Yeah, I will look it up. I will look it up, and I will let you know what I learned myself. Thank you, Jeff.
I mean, yeah, of course. One of the things I saw, which I think is crazy, is you're almost having SPACs raised to take knowing the targets already. Like a company will raise a SPAC to bring itself, it's like umbrella company public. I don't know if I think it was Group 9, I think, which is like the Group 9 Media. They own like the Dodo and Thrillist and all that. I think they raised a SPAC to like take Group 9 public, which is, I don't understand how that's possible.
Yeah, I mean, well, it's kind of similar, probably, like to, you see some of the late stage growth companies, of course, are raising SPACs, and they have many investments, and they're probably going to take one of their investments public, or potentially take, I think if you have meaningful interest if you're the sponsor of the SPAC and you have a very meaningful interest, or maybe even majority interest, what it sounds like from your example, in the acquired company, Yeah,
and this is kind of the stuff which I worry will bite us in the rear down the road.
I agree with you. I think arm's length and fairness of opinion. I mean, this stuff is very important. Again, if you use this product, I think it's a great product to solve real problems. It's great, but I hope the abuse is limited, or the misuse is limited, because that will not be so great for totally. The product.
Well, I think we actually have to stop now. I had an amazing time chatting with you, and congratulations to you on pulling off an amazing IPO. The best is yet to come. We're honored to work with you. And with that, I'll hand it over to Fabrice again. So thank you, Rahim.
Thank you so much, Jeff. Thank you for inviting me and inviting Alpha to this show. And it's been actually awesome to be working with you in the last 2 months, because you also are very much love to get into details and understand a lot of detailed parts of how all this works, which I find very, very, I get a lot of enjoyment out of that. So thank you so much for having me, and thank you for being our partners, man. I think it's going to be great. I hope we can really help some great companies and great founders in Latin America together.
Well, thank you guys for joining. This was super fun. Now let's go and find a company to buy.
That sounds like a plan. We'll have a lot of calls together, all of us.
I'm sure of that. Well, thank you, everyone. I'm sure we'll be doing a show shortly. So thank you for watching this. Feel free to ask questions in the comments section on YouTube. If you have ideas for future shows, let us know. And as you can see, sometimes some of your ideas pan out and we actually execute on them.
Thank you so much.